A little about a new process that we have at our firm that has grown out of just sort of a sense of what I've seen in the marketplace and something that really touches my heart, that I really hate deadlines. And in my experience in doing qualified plan audits, so that's what our firm does. We audit qualified plans, the audit that has to be attached to your Form 5500 filing. And over the years, I've been doing this for a very long time, longer than I care to admit. Over the years, I've noticed so many of these things get pushed out to not just the deadline. Most people don't even know there's a July deadline. They get pushed out to the extended deadline of October 15th. And so many of them that I did a little research on last year's filings. There's a site at the DOL where you can look up all the filings and do some slicing and dicing. So I pulled it into Excel like a good accountant would and sorted it and whatnot. And I noticed that 69%, let's just call it 70%, 70% of all filings last year of plans that required an audit were filed in October or later. So 9 months after year end. And I look at that and I go, where's the auditor been? Where have you been? Why would that take so long? I think it can be done earlier. I think it can be done more efficiently, so on and so forth. So those statistics played into what I had thought was taking place in the marketplace. In fact, 19% of those filings took place on the day, the filing deadline, 9.5 months after year end. And what happens with that? That has a significant negative impact on audit quality. Drives it down. If you're getting that report, some of you have probably been there with these sort of statistics. You're getting that audit report a couple of days or the day it's due. It's your financial statement as a plan sponsor. What opportunity have you had to even look at it, assimilate what in the world is in it, understand what's in it, get any sort of questions answered? Virtually none. You're going to have to attach that thing and file it and move on down the road. From the audit side, what if you found an issue? What if something has happened in the plan that needs to be fixed? How much time do you have to fix it? None. Those are the 19% that go past the deadline. And that can be very problematic also, because the penalty structure in place is significant for late or incomplete filings. So we look at that and we think there's got to be a better way, and we think we've come up with one. So let me step back first. So what in the world is it that we're doing when we do these audits? High level. We're looking to see, in general, is the plan operating the way the plan document was written? Sounds pretty simple, right? Not necessarily. We find issues all the time where the two are out of sync. It's a tax qualified plan, and it's tax qualified because you have a tax qualified document. You must now follow that document. That means people operating the plan, HR, payroll, accounting, all of them need to know what's in that document. If it gets amended, changed, whatever, they all need to know that because they're operating the plan. And another thing that we look at, which is not necessarily, this kind of gets over into a little gray area, but we also are going to look at is the plan sponsor fulfilling their fiduciary responsibilities. First of all, do they even know they're a fiduciary? The answer is yes. If you have any discretionary authority or control over what happens with your company's retirement plan, then you are a fiduciary, and that is significant. Ann's going to talk about that in a little bit. Fiduciaries are personally liable. Personally liable. Home, boat, car, all those things, personally liable for the operation of the plan. Significant. We look at things, because we're specialists in this area, this is all that we do. If we see things of a fiduciary nature that are out of whack, need some attention, we can point those out. Like I say, they're not always necessarily part of the audit, but we might become aware of them doing the audit work. So what are we auditing? We're auditing the transactions through the plan. Contributions, employee and employer, distributions and loans, plan expenses. Is the plan paying for things it shouldn't be and or should be? We're looking at those sorts of transactions. Pretty straightforward. What do we find? What do we find? We find all sorts of things. We, mostly being Patty back here helping us with a little video, we find all sorts of things. No committee oversight. This gets into the fiduciary realm. Is anybody actually looking at the investments being offered by the plan? Are they monitoring them regularly, replacing funds as needed? Segregation of duties. We work with companies of all sizes, from thousands of employees to plans that just hit the audit requirement, which is generally 100. Somebody, oftentimes in some of those smaller companies, is doing the whole thing. They're doing payroll, they're doing enrollments, they're running the plan, they're issuing loans, etc. And nobody's checking their work. So there's no segregation of duties. We see that a lot. We see plans, this is probably the most common error that we see, plans not using the proper definition of compensation. So it comes time to calculate contributions. The plan must have and does have a formula for that contribution that includes compensation as a piece of that, and there's a question of whether or not it's being followed. Big things with bonuses, overtime, unusual sorts of compensation that come up but may not be properly treated. Forfeitures, you should be using your plan forfeiture account once a year. It should be getting zeroed out. So if that forfeiture account is building up, it's time to use those monies. Timely deposits, get the money in within however soon Chris says you should. Typically, we generally look at 5 business days. Chris might tell you something different, but get that employee money into the plan as soon as possible. The issue is, as long as it's in the plan sponsor's hands, it's subject to the claims of your creditors. Well, that's employee money. So that employee money needs to get into the trust where it's protected from the claims of creditors. Required minimum distributions. If somebody's age 70 and a half, they're required to take money back out of the plan. And plan expenses. We'll look at expenses, and we're just looking to see if they're appropriate expenses, not necessarily whether they're high, low, or in between. That's for a consultant that we could bring in.
Yes, can I ask a question on the required minimum distributions? If they're still employed, do they still have to take those?
They do not, unless they're a 5% owner. So, yeah, is that correct? 5% owners do have to take it, but if 70 and a half and still employed, that was a change that happened 3 or 4 years ago, I believe. So if 70 and a half and still employed, they do not have to start their distributions. It's the 70 and a half that are no longer with you. Thank you for that question. So what would we say that you can do about improving audit quality, which is something near and dear to our hearts, and improving efficiency? When you're looking for an auditor, look for someone who perhaps specializes in the area. Plan audits are very unique. I'll give you, big picture audit concepts, auditing a company, so to speak. For auditors, there's a concept of materiality. It's a calculation usually of, based on total net assets or total revenue or something like that. There's a calculation an auditor makes that what's material and what is not. It's usually a pretty big number, believe it or not. With a plan, if $100 is missing out of somebody's account, is that material? I would say, where'd it go? Whose account did it go into? So there's a bit of a disconnect. When you're doing a plan, you really need to know what you're looking at, and that it's a specialized sort of animal. And that whole concept of materiality is calculated, but it might kind of go out the window, because even very small amounts could be indicative of much bigger problems. I would say look for someone that belongs to the Audit Quality Center at the AICPA. Look for someone with experience doing plans, maybe some different industry designations from ASPA, CEBS, those sorts of things. Someone that is actually going to come to you with some findings periodically. It would be unusual to go year after year after year with no findings. I try to help clients understand that you want us to find things before Chris does at the Department of Labor, so we can have options and do a little consulting and have some time and space to fix them. That's why we're there. We're there to look under the hood and point out things that may or may not need attention, and then help you get them fixed. Maybe call in someone like Ann Tyler and her firm, her law firm, and help you get them fixed. And an ability to deliver in a timely manner, which I mentioned is near and dear to my heart. So we came up with a new process, but I'm not going to take complete credit for it. I'm going to give credit for it to a client of ours. I had a client call me up for the conversation of my life. He said, you know, I'd like you out here more often, and we'll pay you more. Oh my gosh, when I got up off the floor, I said, you've called your auditor, are you sure you have the right number? He said, no. He said, this is a plan that had lots of problems in the past. He said, I want you out here during the year that you're auditing. So maybe in Q4, you're going to audit Q1 through Q3 of the same year. So you're out there during the year of audit. So we did that with their plan and with another a couple years ago. And we actually found problems. And they were able to fix them then before year end. So when the year end audit wrap up came and we audited the final quarter, now we've got a clean audit. Everything's been fixed within the year in which it occurred. So it ended up with us going back to them and saying, gosh, you know what? We're not going to charge you more for this. This turned out to be so much more efficient for everyone involved. The records were more readily available. The problems got rectified before they became big problems and became problems for 2 years. That we went back to them and said, no, I'm not comfortable with billing you more. We're going to bill you less. Not significantly, maybe 10%, but it certainly was not more. So when we're looking at new work, we're quoting it 2 ways. You do it this way, this periodic method that we call it. It'll be a little bit less. You could do it the old way. I don't like to do it that way. It'll be a little bit more. So those are the 2 methods. I call them the traditional method. This is the method that most firms use. No knock against that. It's just a business model that most accounting firms have. You know, January 1st to May 1st, their staff is very busy doing tax and corporate audit work, etc. They're not going to have time to focus on doing a qualified plan audit. Because our practice is specialized and we only do plan audits, we do them year-round. So we use this periodic method. So if you're using the traditional method, it's probably what most of you are familiar with. The audit work, as you might know, starts usually in July and August of the year following that's being audited. So let's say, for example, July and August of 18, the calendar year 2017 is going to be being audited. For us, we're going out in Q3 and 4 of 2017 and auditing 2017 first 2 quarters. So we're within the year. That traditional method results in reports being delivered in October. That's when things get done. We push to get reports delivered in May, June, and July for the July 31 deadline. No need for extension. So we're working on converting our existing book of business to that method out by July, and it's going very well. Under that traditional method, as I mentioned, if there are errors and issues found, which happens a lot, and just to give you some sense, when I say it happens a lot, I would say on 20 to 25% of the audits that we look at, there's some sort of issue that needs to be rectified. And when you find an issue in a plan, like I said, it's tax qualified because of the plan document, has to follow it. If it's not, it must be corrected. If it's not, oh, sorry, we'll fix it going forward. Something must be done to fix it. So that takes time and effort and all that sort of thing. So under this method that we're using, that can get done a lot more efficiently and easily and timely. And then the time investment. You can imagine, pulling records a year to 19 months after they happened is not a very efficient process for anyone. If we're out there months after the transactions took place, it's much easier, more efficient for plan sponsors to gather those things that we need and pull them together for the audit file. So that's the process that we have been using. That's the process that if you have questions about, we'd love to talk to you about. Get our clients